This is the average square footage of houses over time, right? In 1970, the typical house was 1,500 square feet. Okay.
Yeah.
Today, the typical house is over 2,200 square feet. Okay. It's much larger. It's a bigger house. So when you adjust for square footage, interest rate, inflation, and house price, what you see is that the Shadowstats adjusted mortgage payment per square foot on the house was 8 cents per square foot in 1970. It was 14 cents per square foot in 1980. It came down again to 7 cents in 1990, and on and on. Today, it's 3 cents per square foot per month.
And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome, empowered investors. This is episode number 1904. Today, we are going to have a little update on inventory and its increase or decrease and where that comes from. We'll have an update on that. We will have an update on the last podcast because things have changed a bit. And I want to thank everybody for reaching out about my big court case and all of your support. That really means a lot to me. So thank you very much for that. I got a lot of messages from you and really appreciate the vote of confidence and support and the happy birthday wishes as well. So thank you for all of that. We had a great call with our Empowered Investor Pro group last night and really appreciate everybody joining those monthly Zoom meetings. Sometimes we have some extra Zoom meetings, but last night was our regularly scheduled meeting on the first Tuesday of every month, and really enjoyed talking to all of you last night and all of your questions. We had a CPA guest and really covered some great stuff. So if you're not a member of the Empowered Investor Pro group, be sure to check that out and join it because you get huge discounts on our events. On our virtual event this weekend, that one is $100 off. And by the way, if you haven't registered for that one, we want to see you Friday and Saturday this week. Just go to jasonhartman.com. Right at the top of the page, you'll see our Recession Proof Investing Summit. And that is a virtual event, so really easy to attend. Join that. So we'd love to see you this weekend at our virtual event. All right, let's dive in. Let's take a look at some inventory. Let me give you an update on the case because we have a new development since the show on Monday. And here we go. Starting off with our friends at Altos, we have some updated inventory numbers, and inventory has increased just a tiny bit. Again, not even really worth mentioning. But the question here is, what is driving changes in inventory? And I wish I had the graphic for you now. If you're looking at the video, I do not have this graphic handy, but of course I have the other one that's on the screen. And that graphic is one I've shared with you in the past of a sink, right? So on a sink, you have a faucet. That represents new inventory, that new water coming into the market. That's new inventory, new listings. And then the sink's drain represents the sales, right? So is the drain plugged up and are properties selling slowly and in lower volume? Or is the drain wide open and the minute new water comes into that sink, it just exits out? In other words, it exits out of the market, right? Those listings get purchased, they get absorbed right away, lickety split. So we're going to kind of take a look at that today before we get to the main part of our show, which is interview with yours truly and an update on the Hartman Comparison Index. So we'll have that in a few minutes, but let's take a look at this stuff. So here we see this line, the kind of burgundy colored line, if you will, or red or burgundy. We see that there's been a little bit of an increase in inventory. We've been talking about that. It's no surprise there. But again, still historically very, very low inventory with only 561,000 single-family homes for sale in the US. And interestingly, Mike's projection here is that we will actually end the year lower than he projected before in terms of overall housing inventory at only 490,000 units for sale. Recently, he projected a higher inventory number than that. I don't recall the exact number, but I know it was a little bit higher. So now this would be more optimistic that there's more of a continuing seller's market. So 490,000 homes at the end of the year. Right now, we stand at about 561,000 homes for sale. Now, compared to what? Well, compared to last year, we ended the year 2021 with only 310,000 homes. So inventory is definitely higher. But then again, compared to what? What Mike calls the recent normal, and that would be 2018, illustrated with a blue line on the chart, where we ended the year with 850,000 homes for sale. Now, I want to just mention something about that. That's what he calls the recent normal, but it's not the overall normal. And of course, this is a matter of opinion to some extent, but what we have now is we have just about one half to about 35-40% of the homes for sale that we need to be called a normal market. So inventory is still extremely low, and again, especially acute in the lower price ranges where you have those properties that we investors like, those entry-level houses that make great rental properties. So the inventory shortage even more acute in that range. Okay, let's look at something else here. Now, this chart is another one that basically shows new listings per week. So this is how much inventory is hitting the market. In other words, with that sink metaphor that I was talking about, how high or low is that faucet turned on? How much water is coming out of the faucet into the sink, right? Because it depends how much is coming in, and it depends how open that drain is into how much is going out in terms of inventory being absorbed by buyers in the marketplace buying those properties. And what we see here is we see that we have fewer new listings, but even though we've had fewer new listings, and why is that? Well, we've talked about it before, folks. We've got 25% of the homes in the entire country with mortgages below 3%. What would possibly motivate those people to sell their houses? Nothing. Okay, just they'd have to be in such incredibly severe, unrecoverable financial hardship to want to sell those properties and give up those extremely bargain basement mortgages, because those mortgages represent a huge asset to those homeowners, 25% of all housing inventory in the country. Now we've got another 40% that is free and clear. So not any distress there, right? Because there's no mortgage whatsoever, right? But let's go back to those 25% of homes with mortgages below 3% interest locked in for the next, well, they've got about 28 to 29 years left on their mortgage. An asset they're not going to want to relinquish because of those incredibly cheap mortgages. What I wish I had for you, and I don't have this statistic, but we can speculate together a little bit, and I think this will be a reasonable speculation. How many mortgages in the country are below 3.5%? We know how many are below 3%. That's about a quarter of all mortgages. But how many below 3.5%? How many below 4%? How many below 4.5% or 5%? All of those mortgages are super bargains. You can't duplicate them. You can't replace them. They are irreplaceable. It's like having a rare diamond, right? You can't replace that diamond. That's why it's so expensive. That's why these mortgages are so valuable, because they cannot be replaced. So again, these are things that have become, well, I'm going to call it what it is. Collector's items. Yes, cheap mortgages are the new collectible. They are collector's items, and collector's items are valuable because of their scarcity, and not in all cases with collectibles, but what I always say are the two primary drivers for valuing anything, right? You know what I'm going to say? Utility and scarcity. Utility and scarcity. Those are the two things that make anything in the world valuable, from a monetary asset, a commodity, a cheap mortgage, a loved one, scarcity and utility, right? That's it. That's the value. And so we see fewer new listings coming on the market, but inventory grew ever so slightly because some buyers are sitting on the sidelines and some buyers can't qualify. So what are they going to have to do? Well, they're going to be forced to rent. and that's going to push upward pressure on rents. And like I've been saying for quite a while now, if you think rents are high now, you ain't seen nothing yet. I know there are times, little cycles, little blips in the market where maybe things take a breather on prices or rents or whatever. But overall, the macro trend, and remember, that's what I do. I pay attention to macro trends because that's what's important. It's not it's not so important what happened last month or last week or on a daily basis watching the market. I mean, those people just never get anywhere because they're too distracted with minutia. You've got to look at the big macro trends, the big picture. That's what matters. You don't live your life daily, weekly, or at least not your investment life, daily, weekly, monthly, even annually. The big trend, the big macro trend is we are going to see much more upward pressure on rents, especially with higher interest rates. Higher interest rates cause higher rents. Those two are correlating indicators. Higher interest rates means lower affordability, means those people cannot move from the renter pool to the buyer pool. And if they're coming into the market, if they're just coming into household formation, buying a house, not an option. Renting, the only option available. So there you go. All right, let's see what's next here. Okay, so save the date for our Scottsdale event coming up on January 27th. This is going to be a fantastic event. It's a 2.5-day conference. We do not have a landing page up for that yet, but we will for those of you attending our virtual Recession Proof Investing Summit this weekend. Get your tickets at jasonhartman.com, and we're going to offer you a big fat discount this weekend. So be sure to join us for that. It's going to be a great event. We've got Tom Wheelwright speaking at both events, both the virtual event this weekend and the live event in Scottsdale. He's the Rich Dad tax advisor. He wrote a great book called Tax-Free Wealth. And we've got Noah St. John speaking, opening our virtual summit on Friday evening, talking about mindset and how to get rid of head trash. I love the way he says that because there's so much trash in our heads, right? We've got to constantly get rid of the head trash. All right, one more thing I want to update you on before we get to the main segment of today's show. That is, of course, the big court case that we just finished up. My judgment was hacked down, and this is common. Look, a jury will make an award, and then the judge will come in, the lawyers from both sides will fight it out, and they'll say, hey, things in this award were duplicative, they didn't apply, it was unreasonable, whatever they're going to say, right? So the lawyers have now duked it out, our lawyers and their lawyers, and we do have a final judgment now, and it got hacked down. But again, it's still a good judgment. So I'm happy with it. And here it is. And I just broke it down for you. So it's on the screen. For federal cyber squatting, the defendants were found liable for $600,000 that they owe to us. For federal RICO, that's the racketeering statute. That means basically organized crime, but there is a civil version of RICO. And by the way, if you're just hearing this for the first time, watch Monday's episode or listen to Monday's episode. Quite a fascinating and rather terrifying story, actually, and just listen to that because our lawyer was on with us, and he tells the story much better than I can. For the federal RICO and conspiracy charges or claims, I should say, including the trademark counterfeiting, that's $9 million. And that was our award there, the final judgment amount. And then the Florida false advertising, $4.5 million. Invasion of privacy and misappropriation of my likeness, that is a $3 million award. And then punitive damages for unfair competition, $5.5 million. Punitive damages for invading my privacy, $5.5 million. So just think of this for a minute. Isn't it great that we live in a society of laws, right? Where people cannot take advantage of people. Now, look, I'll be the first to tell you, it is very difficult to get justice. It is very expensive to get justice. And a lot of people just can't afford to access the system. Fortunately, I could. I was very persistent for 4 years, continuing to just spend money, spend time, go through just massive heartache to pursue this case. It turned out well. But just the invasion of privacy component alone $8.5 million and the misappropriation of my likeness right there with the punitive damages and the, I don't know, what do you call that? The jury award. I don't know if it's the statutory. That's probably the wrong word. I'm not a lawyer. Okay. So I don't know, but that adds up to $28,100,000. And they really hacked the interest down quite a bit. And they gave us pre-judgment interest. Now we're also entitled to post-judgment interest if the defendants don't pay quickly, right? There's the interest accrues on the judgment, but pre-judgment interest, in other words, when the wrongdoing occurred up until the time you got the judgment, which was, just recently, right? They awarded us $338,625. So the grand total of this judgment is $28,438,625. And we will also seek fees and cost and attorney's fees. And, I don't know what that will add, but just estimated here another $1.9 million, bringing the judgment hopefully to over $30 million. It's quite a story. If you did not hear Monday's episode, you really want to go back and listen to that one, because this is a story that will make your hair curl. Is that the right statement? I don't know. I think that's the saying. Anyway, be sure to join us for our Recession Proof Investing event this Friday and Saturday. Just go to jasonhartman.com, get your tickets for that. And now, without further ado, let's get to our main segment. This is an interview I did just yesterday. Talked a lot about price predictions, some new updated data on the Hartman Comparison Index. I think you'll really enjoy this interview. So here it is.
I'm really curious what your perspective of the overall economy is right now.
Overall, my view right now is that the market is clearly changing. These high interest rates are really affecting things, but it's spotty. There's a lot of nuance to it. I divide markets into three major types: linear markets, cyclical markets, and hybrid markets. So right now, and our forecast into the future, is that cyclical markets will continue to soften pretty substantially. And I would be very careful of buying properties in those markets. But linear markets, however, where you're looking below the median price in any given market, are markets where they're still experiencing tremendous housing shortages. Since coming out of the Great Recession for the last, 12 to 14 years, depending on how you count, builders have not built these inexpensive entry-level houses. And so there is just a huge shortage of those properties, and it's going to continue. Why haven't builders built them? Well, they're simply not profitable. It's too expensive to get the entitlements, to put in the infrastructure, pay for the construction materials, the labor. You just can't build them at a profit anymore. And so this shortage in entry-level housing will persist for many, many years to come. And that will be the protection against any downside risk. And that's why I think those properties make a lot of sense. But the problem is that all of the data we see is just looking at the overall housing market. They never really divide it up into cyclical, linear, and hybrid markets, and they never divide it up based on price segments. And so it's really problematic. Okay. And that's what we can take a deeper dive into today.
So how do someone determine whether it's a good linear market or not? Like a lot of people have questions like, okay, am I in a linear market? What's some kind of like factors that people can kind of determine if that's a good linear market or if they are in a linear market?
Well, the way you know if you're in a linear market or a cyclical market is by the prices of land. So land prices are always higher in cyclical markets, and land value can fluctuate dramatically. It has a lot of volatility with it. However, improvement value, okay, and many years ago, I developed something called the Hartman Risk Evaluator. And we're not going to go over that today, although we could maybe another time. But basically, what it does is it teaches people how, when they buy a property, most people think they're buying one thing, and they're really buying two things. They're buying the land and the improvement, or the house or the apartment building sitting on that land. And land prices are very volatile. Improvement prices, the house, the apartment sitting on that land, not very volatile. Why? Because it is made of materials, commodities. And I call this packaged commodities investing. So if you think about it, just look at the ingredients of a house, right? So look behind me, I'm in my house, and you've got these walls, right? You've got drywall, you've got lumber, you've got concrete below me, you've got petroleum products throughout. I've got glass and steel. I've got copper wire in the walls. All of these commodities are traded globally, and they're not attached to any one currency. They have intrinsic value, regardless of whether they be traded in the dollar, the euro, the yen, or the peso. It doesn't matter. They have intrinsic value, and they are much less volatile than land prices, which can go up and down very, very quickly. And so linear markets have a low land value component and a high improvement value component, or packaged commodities component, because I call it packaged commodities investment. We buy all these commodities, they're packaged up in the form of a house or an apartment building, and they're not very volatile. I mean, yes, commodity prices, of course, go up and down. The price of copper changes, the price of oil changes, which are the petroleum products, drywall, lumber, concrete, etc., glass, steel, they all change, but not nearly as quickly as land prices.
So you're looking at basically deals that when you look at the even the tax assessment, majority of the value is in the value of the property, not in the value of the land.
Yeah, well, the value of the improvement, the house sitting on the land. The property is considered the whole thing, right? That's what people mostly sort of incorrectly call it, right?
Yeah.
They say, yeah, I bought a property. It's a piece of land with a house on it, right? So yeah, we like to see a ratio somewhere in the neighborhood of 80-20. So if 20% of that is land value and 80% is improvement value, that's pretty good. Now, that ratio, as prices have gone up, has become more and more out of sync. So maybe nowadays it's more realistic to look at 70-30. But if you're looking at a property in Los Angeles, where I grew up, for example, or Miami, which is just about an hour south of me, I live in Palm Beach, Florida, you're looking at very high land values. It's almost the inverse equation. And so those can fluctuate much more dramatically.
So is that where you see the biggest correction is going to be in land? Because they're doing I don't really understand fully what the Fed's doing. I feel like they're almost trying to force a crash.
Oh, they are. Yeah, they're going to put us into a recession one way or another. I mean, if we're not already in one, and that's debatable, of course.
Yeah. Why? Why do you think they're trying to do that?
Well, they've got to cool inflation. So there's something in economics, there's a major principle that's important called the Phillips Curve. And the Phillips Curve is the equation where you try to balance unemployment on one side against inflation on the other side. Because when the economy runs hot, you're going to have inflation, where you have more dollars chasing a limited supply of goods and services. You're going to have wage inflation, you're going to have consumer price inflation, producer price index inflation. All of these things will inflate in price, right? When you have more dollars chasing limited supply of goods and services. And you'll usually have very low unemployment in that environment. So as they bring up interest rates and tighten the money supply and rein it in so there are fewer dollars chasing the existing supply of goods and services, then those prices will subside and inflation will calm down. And the Fed's target rate is 2% inflation, okay? So we are way above that now, and their mandate is to keep this balance between, a good, healthy economy with fairly low unemployment and low inflation at the same time. And, it's hard to do both, right? And I am hugely critical of the Fed right now. They have completely screwed this whole thing up. They let the economy run way too hot for way too long with these ridiculously low interest rates. They should have raised rates much sooner and much more gradually. And now they're raising rates too quickly, and they're behind the eight ball because inflation is out of control. So it's a difficult problem to solve. They have really put us into a mess.
Yeah, because it was, I think back in January, it was about 3.5%. And now I believe it's up to like 7.5%. That's a
Oh, no,
massive.
it's higher than that. And that's just the official numbers. I mean,
Yeah.
the unofficial numbers, I believe, are 15 to 17% inflation right now.
Yeah, I was talking about the interest rates. Interest
Oh,
rates
oh
from
yeah, got ya.
3.5 to 7.5. So I know you love like using debt for real estate. Do you still see the value of using debt even if it's at like 7.5 to 8%?
Well, that's a good question. And the question there is compared to what?
Yeah.
Because, which I believe, as you know, is life's most important question.
Yeah.
and I talked about that in the speech that you saw. You have to compare the cost of money with the cost of inflation, right? Because when you have inflation, it's let's use 15%, and you can borrow money at 6%, the delta between the two is 9%, right? That's the difference, okay? So inflation is still paying you to borrow money. We still have negative real interest rates compared to inflation. Because if you're a lender, and I'm a lender, by the way, I do hard money loans, I do private loans all the time. And so when a lender loans money and they're saying, here's the money at today's value. If I give you $100,000, that $100,000 is, you could spend it today and it would be worth $100,000 of whatever goods and services you could buy. But if you're going to pay me back over the course of 5 years, for example, I know that officially at inflation around 9%, I'm going to be losing $9,000 the first year I loan you that money, because you're going to pay me back cheaper dollars than I gave you, right? So comparing the interest rate I might charge you of, say, 6% in that example before, and a real inflation rate, well, an official inflation rate of 9%, you're getting paid 3% to borrow the money in that example. The unofficial rate of 15%, which I believe is a more accurate number, you're getting paid 9% to borrow the money, because you get the use of it today and you pay it back in cheaper dollars tomorrow. It's a very, very good deal. And I actually trademarked a term for this years ago, and I'll just share it on the screen. I call this inflation-induced debt destruction. And I've been teaching that strategy for about 18 years now, and it is really the hidden wealth creator that can be used most successfully with income property. Real estate has very special characteristics that make it the most historically proven asset class in the entire world, one of which is inflation-induced debt destruction, but there are other great characteristics too.
Yeah, I don't think I've ever I've seen your breakdown for your inflation. Is that part of like a program you do, or?
Well, yeah, I mean, I teach all kinds of things on my podcast and my YouTube channel and at our live conferences. One of them is the inflation-induced debt destruction strategy. The other is the Hartman Risk Evaluator, and there are many, many other things. One of which you heard me talk about is the new index I've developed called the HCI, or the Hartman Comparison Index, which basically helps people compare the value of real estate to a whole basket of things rather than just one thing, which most people compare it to, which creates huge blind spots. I mean, think about it. The vast majority of people, almost everybody, compares the value of a house to one thing, the US dollar.
Yeah.
Why would you do that? The US dollar is a moving target. The house price is a moving target. You're going to have a ton of blind spots if you don't use multiple measuring sticks to compare and understand value with. So I want to jump right into the Hartman Comparison Index. And here, what we see is we're going to compare the typical house to not just US dollars, but also to gold. Now, I'm not a gold bug. I just think it's a good measuring stick. Okay. Gold has been considered money for thousands of years, and it's worthwhile to use this as one of our comparisons, and the first one actually. So if we look at back in 1970, the median home price was about $23,000 and gold was $35 an ounce. So it would take 654 ounces of gold to buy the median price house back then. But 10 years later, the median house had tripled in price to about $63,000. And gold had gone way up in price too, to $653 an ounce. So 10 years later, it only took 97 ounces of gold to buy the median price house. Now, we can go through the decades, and we just did an update bringing us up to last month. Okay, so this would be very current data. Now, last month, the median house price, and by the way, this varies a little bit depending on what survey you're using, okay?
Yeah.
The one we use prices the median price house at $390,000, basically. And gold at just over $1,700 an ounce. So it takes 227 ounces of gold to buy the median price house. At the end of the second quarter of this year, it took 228 ounces. So it actually got 1 ounce cheaper. At the beginning of the first quarter, it was only 197 ounces. So it was a lot cheaper back then. And historically speaking, the most expensive it was in 1970 and in 2000. In the year 2000, 22 years ago, it took 520 ounces of gold to buy the median price house. So the question we have to ask ourselves is, priced in gold, are houses cheap or expensive? Now, we break this down also based on linear markets and cyclical markets as well. But again, we could talk about this for 8 hours and we wouldn't cover the subject. There's a lot to it, okay? So just in the interest of time, I'll just move on. But the question to ask yourself, priced in gold, is housing cheap or expensive? The answer, it's not the cheapest it's ever been, and it's not the most expensive it's ever been either. It's kind of in between.
Yeah.
Okay, let's look at another thing. We're not going to look at Bitcoin. That's too volatile, okay? But let's look at oil. Oil is a really good one because it's one of the most important commodities in the world, oil. No matter what the tree huggers and the green weenies want to say, the world still runs on oil. No question about it. So in 1970, that median price house was about $23,000. Oil was $4 a barrel. It took about 6,400 barrels of oil to buy the median price house. Today, median price house is about $390,000. Oil's just under $100 a barrel. And of course that changes hourly, okay, but at the end of last month. And it would take only about 4,100 barrels of oil to buy the median price house today. So priced in oil, housing is actually cheaper than it was 52 years ago.
Yeah.
Just think about that for a minute. It's also cheaper than it was a year ago. In 2021, it's actually cheaper priced in oil. It's cheaper than it was in 2020. In 2020, 2 years ago, a median price house was only $309,000, but oil was $47. So it took 6,600 barrels of oil to buy the median price house. What if we go back 12 years? Let's go to 2010. House was $170,000, oil was $89. It only took 1,900 barrels of oil back then to buy a house. So it was cheaper back then. And you can see it varies over time, okay? I'm just trying to get people to look at multiple ways to price things. Okay, so let's look at rice though for just a quick moment, because rice is the basic food stock of 2/3 of the entire world's population. It's a really important food commodity. And so back in 1970, where we start, it took 43,000 hundredweight bags of rice to buy a house. Today, it only takes 22,000. So priced in rice, housing is actually very cheap right now. It's almost the cheapest it's ever been. It was a little cheaper in 1990, but pretty much otherwise, it's about the cheapest it's ever been. Okay? All right, let's talk about interest rates and let's price for that. So when we look at mortgage debt service payments as a percentage of disposable household income, we see, looking at the end of this chart, that it's pretty low. Mortgage payments are actually pretty reasonable for people, historically speaking. Now, they were much cheaper during the COVID lockdowns. Okay, that was the cheapest time.
Your white screen's actually blocking the
That is very much intentional.
Oh, okay.
So now I'm going to remove that and we're going to go back further. Okay. So let's go back to about 2014 and we see right now the mortgage burden for the typical household is actually quite low. People are complaining that mortgage payments are so high. Compared to what? Yes, I know. Compared to the cheapest point where we had the lowest interest rates in literally 5,000 years during the COVID lockdowns, and house prices were very cheap then too because they hadn't risen yet in response to those low rates. Yes, I know it's more expensive than it was then, but that was a total anomaly. You've got to step back and look at the bigger picture. Mortgage payments are still pretty darn reasonable. Let's go back even further. Let's go back to 1984, okay? Or no, I'm sorry, this is about 1980, this chart starts at. And if you look at the mortgage debt payments as a percentage of disposable personal income, it's cheaper than it was in 1980, 1985, 1990. All along, the only time mortgage payments have been cheaper than today are during the COVID era. Otherwise, historically, big picture, going back to about 1980, mortgage payments are the cheapest they've ever been, with just those exceptions during the COVID era.
Yeah.
Counterintuitive to what people think. Okay. All right. Let's look at the real mortgage payment priced adjusted for inflation. Okay. So we start out at 1970 again, 52 years ago. And a mortgage payment on the median price house back then was $127 a month. But of course, over time, that $127 is debased by inflation because inflation eats away at the cost of things. So the nominal mortgage payment today, nominal just means in name only. That's just the name of something. I still call a dollar, even though it had the same name back in 1970. It's still called the same thing, right? The nominal mortgage payment today is $1,810, but adjusted for the official rate of inflation, not the real rate, because we know it's totally understated and manipulated, as we talked about earlier. The real mortgage payment today on the median price house is $238. Now, that is more expensive than it was 52 years ago. No question about it. It's not the most expensive ever. It was actually more expensive in 1980, where it was $253. And it was more expensive at the second quarter of this year at $261.
Yeah.
But other than that, it is more expensive than it has been historically. But what if we adjust for the real inflation rate? Now, I've interviewed on my podcast the founder of a website that everybody should know about called Shadowstats.com. And his name is John Williams. And what he does is he calculates real inflation based not on his own idea or opinion. He simply does it the way the government used to do it before they started manipulating the index so heavily.
Yeah.
Okay. And by the way, when they started doing that was around 1980. So if you calculate it the old way, the government's official way, and you apply that to today, let's look at what we come up with. So again, we got that same $127 in 1970. We go through time and there's inflation. The nominal payment today is over $1,800. Adjusted for the official inflation rate, it's $238. But if you calculated it the way they used to have the official rate of inflation, it would only be $70 as of the end of last month. So priced for housing prices, inflation, and interest rates, are houses cheaper or more expensive today than they were 52 years ago? They are cheaper, almost by half.
Why did they switch from how they used to do inflation to how they do it now? Why did they switch? Just manipulating on what?
Because the inflation rate was very high in the late 70s and early 80s, and they wanted to find a better way to lie to us.
Yeah, I got you. Because they manipulate the CPI all the time, don't they?
Oh, of course, that is the measure. So when I say inflation adjusted mortgage payment, that is the consumer price index. What the next column is the Shadowstats index, which is the old way of calculating the CPI.
Oh, okay.
Just remember something. When the inflation rate is high, the public doesn't tend to vote you back into office.
Yeah.
tend to lose your job, okay, if you're a politician. And remember that all the government benefits like Social Security and all the government employee payroll is indexed to inflation.
Yeah.
And the government is now about 20% of the economy.
That's
The government employs so many people, and if they have to give COLA wage increases, cost of living index wage increases, they have to do it at the official rate of inflation. So if you can understate the official rate, you get to pay less, give a smaller raise.
Yeah.
Okay?
Makes sense.
Now, just let me wrap up on this concept here on the chart that you see on the screen, because a lot of people might be saying, Jason, that's ridiculous. Are you kidding me? I was alive in 1970, and I remember, the house my parents paid the mortgage on, the $127 a month if it was the median price house, right? And, no way. Like today, I can't even afford a house. I'm the child of that parent that owned that house, right? But I would really encourage you to think more clearly about that. And here's why. We as humans do something called hedonic adaptation, okay? And hedonic, the root word of that is hedonism, pleasure seeking. We're all, hedonistic and we seek pleasure, right? So how much pleasure do we get out of something? And what we do is we adapt to things. We take things for granted after a while, right?
Yeah.
And we take for granted how the house we live in today, even though we think it's so unaffordable, is a lot better than the house we lived in when we were a kid in 1970, okay? And it's a lot bigger. This is the average square footage of houses over time, right? In 1970, the typical house was 1,500 square feet, okay?
Yeah.
Today, the typical house is over 2,200 square feet, okay? It's much larger, it's a bigger house. So when you adjust for square footage, interest rate, inflation, and house price, what you see is that the Shadowstats adjusted mortgage payment per square foot on the house was 8 cents per square foot in 1970. It was 14 cents per square foot in 1980. It came down again to 7 cents in 1990, and on and on. Today it's 3 cents per square foot per month. We're getting more house for less money than we did 52 years ago. Yet the vast majority of people do not see this because they're not really looking at the nuance.
Does Shadowstats website, do they show you exactly how they come up with their algorithm and how they...
Oh, they've got tons of articles and things about it. But remember something, it's not their method. It's not their algorithm. It's the government's method.
I got you.
It's just the way they used to do it before 1980. That's all it is. It's not something they made up. It's what the government made up.
So I get asked this one question all the time. They think interest rates are going to go back down. I'm just going to wait out and interest rates are going to go back down to what they were lowest back in the last 5,000 years. Do you see that happening, or are they just...
I don't think they're going to go down that much again. Okay. That was a real anomaly. Okay. Yeah. And by the way, there are records of interest rates for 5,000 years. Okay. I got a great book recommendation for everybody. It's by the late David Graeber, who was a really interesting guy. He had an interesting way of looking at things. And the book is called Debt, the First 5,000 Years. Okay. Yeah, it's really quite good. You should definitely read that book. So I don't think the rates will go down that low, but I do think the Fed will kick us into a recession. It's debatable whether we're in one now or not. I mean, unemployment's so low that it's hard to say we're in a recession, but whatever, there's a lot of metrics. Okay. So they'll kick the economy into a recession. Inflation will cool off. And then everybody will be complaining that, times are bad. You got to loosen the money supply, and they'll lower the interest rates. They might even do more quantitative easing. Then that will turn things around. Now, here's one of the great things about real estate. Okay. Mostly when you buy something, once you negotiate the deal to buy it, that's the deal. You're done. You paid the price, the seller accepted a certain price, the deal's over. It's done. But the beautiful thing about real estate, especially income property, which is different than real estate because it's used for rental and has different characteristics than just a house you live in,
Yeah.
okay, is that you can constantly renegotiate the deal over time. The deal you agree to today is not the deal you're stuck with. So for example, if someone buys a property today, now I don't know if you sell properties or not, but we do.
Yeah, I
right?
do. I do a lot.
Okay, so like if people went to my website or your website and they bought a property, right? They might think, oh gosh, this deal, it's not as good as it used to be, but I still got to put my money somewhere. I know if I leave my money in the bank, it's going to get eaten alive by inflation. The stock market's a disaster. The crypto market's a disaster. Compared to what? What else am I going to do? Real estate's still the last man standing. It's the best thing, okay? As it usually is. So say they buy a property today, although they're not that impressed with it because they're paying, over 6% on the interest rate on the mortgage. If we go into that recession and the Fed lowers the rates, you just refinance in a year and a half.
Yeah.
Okay. So you can constantly renegotiate the deal along the way. That is one of the beautiful things about income property.